Derek, thanks for joining me. You have Derek and Brian Bohr here of Bohr Insurance Group. Today's webcast is going to be short and sweet, just like Derek. Here we are today, halfway through 2023, with an update in the insurance field. We've been seeing this coming. We've been talking about what's happening behind the scenes, but here we are, and it's all starting to come to fruition. 2020, of course, had no-fault reform. 2021 had COVID shutdowns. 2022 had COVID refunds. 2023 has rising insurance costs. What's going on, Derek? And tell us in terms that even someone like me that reads at a third grade level could follow along at. What's happening in the insurance field?
Well, I never got past second grade, so how about a second grade level? Will that work for you?
Even better.
All right. So I think at the core of it is an insurance policy is nothing more than a payer of products and services, right? You get into a car accident and you have medical expenses, it pays for the treatment that you receive at the hospital. You have to have your front bumper replaced because you rear-ended somebody. It's going to pay for the cost of a new bumper plus the labor associated with installing it. You have hail damage to your roof. It's going to pay for the new shingles plus the roofers to go up there and do that work. So at the end of the day, the insurance policy and its pricing is very dependent on the cost of those products and those services that are going to be used if there's a claim on that policy. So the other piece of it is, of course, the likelihood of a claim occurring. So we're looking at what it has to pay when something happens and the likelihood of a claim being triggered on the policy. So obviously, the likelihood of a claim happening has not decreased over the last 5 or 10 years. In fact, the likelihood of claims have increased during that time period. And the cost that insurance companies are paying for those products and services have increased over that time period as well. They've increased a little bit more than insurance companies probably expected over the last couple of years. So we're seeing some rating impact because of that.
So interesting. In this graphic that we're illustrating here, which of course is a very small snapshot of a multi-million-dollar industry with thousands and hundreds and thousands of clients participating. But here in this little snapshot, you see 14 clients there, and the insurance industry with billions and billions of pieces of data and all their statistical computing power. They said, okay, we think that 2 of those 14 people are going to have claims, and we think we're going to pay out $1,900 on, maybe it was a hit while parked claim, and $8,400 on, let's say it was a deer claim. But what actually happened, of course, is that they paid out those 2 claims, and they paid out a third claim as well. There was an uptick in the number of claims that were being filed. But more important than that is if you look at the claim amount that actually went out the door, instead of $1,900 and $8,400, it was $2,700 and $10,300 combined with an additional claim that was also filed. So again, we're looking at a micro scale here, but the whole point of what's occurring in the insurance world is that more money is going out the door in claim expenses than is coming in premiums collected. So the insurance company, of course, has to try to anticipate and predict the number of claims that are going to be filed, and then the average amount that's going to go out the door per claim. When that is off and they don't collect enough premium, obviously one thing is going to happen, right? So why now, Derek?
Yeah, well, that's a really good question. I think if we look back at the 2022 results for insurance companies from a personal line standpoint, home, auto, boat, travel trailer, that type of thing, insurance companies paid out $1.11 for every dollar that they brought in. So needless to say, they obviously need to have at least an 11% rate adjustment just to get even if the claim expenses are not going to increase and the frequency is not going to increase, both things that will probably occur. So what's happening right now and why we're seeing such drastic premium increases is that the state of Michigan has to approve all rating adjustments that insurance companies make. Whether it's a rate increase or a rate decrease, the state of Michigan has to stamp their approval on it. So when do they approve rate adjustments? Only when the insurance company has statistical data that warrants a rate adjustment, right? The insurance company is not allowed to just say, we think this is what's going to happen in the future, so we want to increase or decrease our rates. They have to say, looking back at a historical period, to traditionally 12 months. This has been our experience from a claim standpoint. We need to adjust rates going forward to account for what's going to be paid out based on what we've seen in the past. So yes, we had inflation starting in 2020 and 2021 and 2022, but the insurance companies did not have enough statistical data from a claim standpoint to validate a rate increase to the state of Michigan. So we saw inflationary increases in premiums during that time period, but realistically, if you broke down that consumer price index, which, you know, we all saw inflation of somewhere between 6 and 10%, depending on, you know, which study you believed. But if you looked at the auto insurance component of that CPI, the cost of new vehicles, the cost of rental cars, the cost of repairing a vehicle, or the home and real estate component of it, the cost to build a new house, the cost to repair one, the mitigation for water damage or smoke damage, those were significantly above that average inflationary rate of 6 to 10%. So we're finally seeing that come through the insurance industry, and the insurance companies now finally have that historical data to say, hey, we're paying out way more than we're taking in order for us to stay in business and continue operating in the state of Michigan. We need to make rate adjustments. And the state has, of course, obviously said, yes, we understand. We want there to be insurance competition here. We want all these insurance companies to be players in our state. Please keep doing business here. We, of course, are going to allow you to adjust your rates to make sure that you can continue to operate here.
So in simple terms, really, insurance companies are paying claims in today's dollars and in today's expenses, yet they're collecting premiums based on where those expenses and where those premiums were a year or two ago, which simply doesn't keep up with what's going out the door in terms of claim payments.
Bingo, you got it.
Interesting. Okay, very good. Well, hey, thanks for jumping on, Derek. I, again, generally can read at a third grade level. You did that at a second grade level. I would say it was maybe a notch or two ahead of that, but I did follow along for most of it. Appreciate that guidance, right? These are challenging conversations. Nobody wants to have to pay anything more for a product that they already don't want to pay for. That is a challenging thing to have to do. It's an important budgeting piece. So at the end of the day, you want to make sure that you have the coverage in place that you need to have, because at the end of the day, these expenses that insurance companies are paying for are getting greater and greater. That could take a much larger chunk out of your monthly or annual budget. So having the appropriate coverage is more important than ever. And then helping to manage that with certain deductible decisions, different coverage choices, right? Massaging what you have to make sure that it makes sense is more important than ever. So thanks for sharing that with us, Derek. I think it's important to understand what's happening behind the scenes and then moving forward accordingly.
Absolutely. Thanks, Brian, for your insight. Really appreciate it.
Got it.